It's a big misconception that you actually own the money that you have in the bank, when the truth is the bank owns your money, and that means your money can be used to bail them out. In this video, we're going to explain bank bail-ins, what they are, how they're legal, and what you can do to protect your assets before the next financial crisis. Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And Brian, I think this might be one of the most important videos we've done because, as the banking crisis last week showed us all too clearly, the banking system is fragile.
Yes, it is. Honestly, Michelle, I've never seen the volatility in bank stocks that we've seen in the last 4 trading days. Some of these moved 60, 90% down just because of the fear of the contagion effect that was in the streets out there.
Sure.
This could have gotten real ugly real fast, and we're hoping this incident was isolated.
Hoping is the operative word there. All right, so let's get to it. What exactly is a bail-in? All right, so a bail-in is when a failing bank uses depositors' funds, that's your money inside the bank, and the debt that's owed to creditors to save themselves and keep going. Whereas bailouts help prevent creditors from taking on those losses, bail-ins mandate creditors take the losses. So basically, what this means is that when a bank needs to recover the money that they lent out, or they can't get back, or they mismanaged, they have the authority to use the money within their banks. Again, this is your money we're talking about, to recoup their own capital. So it looks like this. Let's say failing bank X takes your deposits, and then it's going to convert it into bank stocks. So they take your money in the bank and say, instead of your deposit account, you now own stocks in a failing bank, and you own them whether you like it or not. And by the way, this is 100% totally legal. Now, anyone who has a bank account that exceeds the $250,000 FDIC insured limit would be affected. Anything above that amount can be used for bail-in purposes. Keep watching this video because we are going to talk a little bit more about FDIC insurance and how it all plays into this later into the video. So now, to really understand how the bail-in came to be and the legislation behind it, unfortunately, we have to go back to the 2008-2009 financial crisis. So Brian, I'm going to throw this to you. Why don't you take us down memory lane for us?
Yeah, I hate going back to that one,
I
but
know, right?
here we go. The 2008 financial crisis began with cheap credit and lax lending standards that fueled a housing bubble. When the bubble burst, the banks were left holding trillions of dollars of worthless investments in subprime mortgages.
Yeah.
Bear Stearns collapsed. Fannie Mae, Freddie Mac, both seized by the U.S. government, and then Lehman Brothers fell that September. A month later, in early October, the Wall Street bailout package was approved, and the Treasury loaned $200 billion in loans to financial institutions. We all learned what too big to fail looked and felt like. Banks got bailed out, gave themselves bonuses, and the public got nothing. And nearly 10 million Americans lost their homes during this time frame.
Well, the public got nothing, but we had to pay for greedy banks to get bailed out. So maybe we did get something.
They used taxpayer money to bail out the banks, and people were ticked off.
Yeah.
And here's where the bail-in comes in. The term bail-in was coined by 2 guys from Credit. I can't even say that.
Credit Suisse.
Credit Suisse. The term bail-in was coined by 2 guys from Credit Suisse Bank, 2 bankers, in January of 2010 Economist article called From Bailout to Bail-In. In it, Paul Colello, head of Credit Suisse Investment Bank, and Wilson Irving, former chief risk officer, proposed a new process for resolving failed banks. After too big to fail didn't sit well with the general public, who knew that, right?
Right.
Congress went and passed the Dodd-Frank Wall Street Reform and Consumer Act in 2010, and Title II of this legislation opened the door to allow banks to use depositor funds to bail them out. It effectively ended bank bailouts and made bail-ins possible.
Yeah.
The provision in the Dodd-Frank Act gave the Federal Reserve, the SEC, and the FDIC, and this is a quote, the authority to place bank holding companies and large non-bank holding companies in receivership under federal control. Since the principal objective of the provision is to protect the American taxpayers, banks that are too big to fail will no longer be bailed out by taxpayer dollars. Instead, they will be bailed in.
My favorite part of that is how this is supposed to protect the American taxpayer, when in reality, banks and government got together and came up with a new way to help failing banks, which is to make it legal to take our money.
And it's not only the US this is legal. The US was the first to pass bail-in legislation, but the UK and EU also passed similar laws.
Yeah, there's been a few that have followed since.
Right.
It's interesting. They tested this on Cyprus. Remember all
Oof.
that? 2013? Everybody was like, what is going on over there? So I think it's important that we talk about it real quickly because that experiment can teach us a lot about what the reality of a bail-in might look like if it happened here.
Yeah, this is a great example. In 2013, the European Union decided to take money from the accounts of Cyprus citizens in order to bail out the country.
Yeah.
Those account holders who had 100,000 euros or more in their bank accounts had 9.9% of their money levied. Those with less than 100,000 euros had 6.7% of the money taken, despite the fact that their money was insured. This bail-in wiped out life savings, college funds, and pensions of thousands of Greek middle-class people. And this was done without any warning.
It's really sad and it's terrifying, especially since the insurance promise was ignored for many Cyprus depositors with less than 100,000 euros. And even worse, depositors lost their lawsuit to recover those funds, with the court concluding that those filing the claim, and I'm going to quote this, quote, did not succeed in demonstrating infringement of the right to property. That's scary.
That's scary. This is a great segue into the FDIC. A section of the Dodd-Frank Wall Street Reform and Consumer Act includes protection for depositors by the FDIC, which insures each bank account for up to $250,000. Bail-ins allow banks to confiscate money in accounts that exceed the FDIC insured $250,000 limit.
Well, the real question here is, in the next financial crisis, should there be massive bank runs or these bail-ins, will the FDIC be able to cover its promise? I know I'm not holding my breath because the FDIC has to currently insure $9 trillion in assets. And yet, as of the end of 2022, they only have $120 billion in assets to cover their promises to depositors. And that's only 1.27%. I'm going to say that again, 1.27% of its holdings that are in reserves. And that fact alone does not make me feel confident.
Yeah, and we got to go back to the FDIC. Since the FDIC is backed by the full faith and government credit of the United States government, this means the government guarantees the funds that are insured by the FDIC. But you've got to have trust and believe in what they say. And lately, the negativity that surrounds this subject has turned more people sour on trusting anything.
That's an understatement. Really, it is. Yeah. And it's also sad. I shouldn't make fun of it, but personally, I don't trust what anything our government says. So, and just in light of the Cyprus thing and how much they have in current assets to cover all this, it just doesn't make me feel good. So we'll go down that rabbit hole another day. Just leave it at that. But before we get into how you compare a pair, I would love it. Brian and I would both love it. If you'd like this video, help us grow this channel, please share this video with anybody that you know that could benefit from knowing this information. A lot of people do not know it, and we all need to wake up to what's coming our way, because It is. Let's face it. All right, Brian. So let's dive into why we're all here. What can we do to prepare for a bail-in, or can we?
Just make sure that you spread your money across different financial institutions.
Yeah.
Don't put too much in one bank. Don't keep more than $250,000 in any given account.
Yeah. Should the FDIC hold up its promise, that's what you want to avoid, right?
Go with the limits of today and don't go over it.
Sure. Okay. I have a quick question. Do you think smaller banks will have less exposure than larger ones? Should there be some sort of global financial crisis?
Now, they may have less exposure, but honestly, go back to what the FDIC guarantees. It doesn't matter if it's a small bank, a regional bank, or a large bank. Okay. That $250,000 is still covered in any one of them banks.
Okay. All right. So what's another tip you have for us on how to prepare?
We've talked about this many times. Keep cash on hand to live for a few months. Fiat's losing value, but it's better than having nothing should your money get taken by the bank.
Absolutely. 100%.
Another thing is, how about buying some gold and silver? Gold and silver have both skyrocketed this week, along with cryptocurrencies like Bitcoin, Ethereum. They're not centralized crypto like stable coins. Keep in your wallet.
Yeah. Well, that's the big thing about Bitcoin, Ethereum. Those are the two big ones, right?
Right.
Saving in Bitcoin specifically, it's a hard asset, and you control that money. It is in your possession. You don't have
At
to worry
any
about
time.
your wallet going bust because it lent out too much.
Well, that's funny because this whole week, what was happening, transpiring with the banks, people
Right.
running to the banks, pulling cash out, this, that, and the other. I just looked at my wallet, go over to this screen over here, click on my wallet,
Yeah.
and yeah, everything's still good.
Yeah, exactly. All right. So we're going to drop a video below on the danger of CBDCs. This is another thing we all need to be watching because they are coming, or what the Fed will call the Fed coin. It is coming. Make sure to check out that video because it is. I'm convinced this is coming faster than we all think it is. So before you
Can
get a surprise,
can I drop a line on that subject real quick?
yeah, go for it.
I driving down the road last night, I heard on, I won't say what channel, it doesn't matter, on a news channel. And the news channel was talking with South Dakota governor
Uh huh.
who stated that the legislation in the state tried to push through a CBDC inside one of their bills, slip it into a bill, and thank goodness that they read the bills
Oh,
before they voted on them. But they tried to slip it in and also not allow banks in that state to allow companies that deal in cryptocurrencies to bank with them. Luckily, it was thrown out.
I'm just going to breathe on that note.
Yeah, it was like, wait a second, they made headline news last night. It's like,
Sure.
woo,
Listen, I think this is, again, just your story right there is really important why we should all be on top of this. Whether you're in crypto or not, it doesn't matter.
yeah,
They are
no.
coming for our money. They've made that very clear. They're not even hiding it anymore. So go check that video out. Wow, Brian, you took my breath away with that
Sorry.
news story. I'm like, I really need to breathe. No, but seriously, go check that out and share this video with your friends.
Right.
Also, like it. Please help us grow this channel. And don't forget to subscribe. All right, Brian, this has been a great
Eye opener.
conversation today. Really appreciate it. Thanks to your expertise. And also thanks to everyone who watched.
Thanks, everyone. Have a great day.
Bye-bye.